AI is powerful, but not perfect. Over the last few years, artificial intelligence has gone from being a futuristic idea to something we use almost every day. It writes content, analyzes data, automates systems, and even helps people make financial decisions. In the world of investing, AI has quickly built a reputation for being smarter, faster, and more efficient than traditional methods. And to some extent, that reputation is justified. But there is a problem. The more powerful something appears, the easier it becomes to overtrust it. And that's exactly what's happening with AI in investing. Many beginners are starting to believe that AI can replace human thinking completely, that it can predict the market, avoid losses, and generate consistent profits without mistakes. And while that sounds appealing, it creates a dangerous illusion, because the truth is simple. AI is powerful, but it is not perfect. And if you don't understand its limitations, you're not just using AI, you're relying on it blindly. This video is not about rejecting AI. It's about understanding it properly. Because once you understand where AI works and where it doesn't, you can use it much more effectively. AI depends on data, and data is never perfect. At its core, AI is only as good as the data it receives. Every recommendation, every analysis, every insight comes from patterns found in historical information. But here's the issue: data itself is not perfect. Financial markets are influenced by countless factors, and not all of them are captured in data. Human behavior, political decisions, unexpected global events, these elements can reshape markets instantly, and they don't always follow historical patterns. There is also the issue of data bias. If the data used to train or inform AI is incomplete or skewed, the conclusions drawn from it will reflect those limitations. In simple terms, if the input is flawed, the output will be flawed too. This creates a hidden risk. AI may appear confident and structured, but that confidence is based on data that may not fully represent reality. And that's something many beginners overlooked. One of the most misunderstood problems in AI-driven investing is something called overfitting. Overfitting happens when a model becomes too focused on past data. It learns patterns so specifically that it performs well in historical analysis, but fails when applied to new, unseen situations. In investing, this is a serious issue because markets are not static. They change. Conditions evolve. What worked in the past does not always work in the future. An overfitted system might identify a pattern that appears reliable, but that pattern may only exist under specific historical conditions. When those conditions change, the strategy breaks. To a beginner, this can be confusing. The strategy looked perfect on paper. The data supported it. But in real time, it doesn't perform the same way. And that gap between theory and reality is where losses happen. Financial markets are constantly evolving. New technologies emerge, regulations change, economic conditions shift, and global events reshape the landscape. AI relies on patterns. But when the environment changes rapidly, those patterns may no longer apply. For example, a strategy that works in a stable economic environment may fail during a crisis. A model trained on years of steady growth may struggle during sudden volatility. Humans, despite their flaws, have one advantage here: adaptability. They can interpret context, adjust their thinking, and respond to new situations in ways that data alone cannot fully capture. AI can adapt, but it depends on updated data and retraining. And that process takes time. In fast-moving markets, time matters. One of the biggest strengths of AI is also one of its biggest limitations. AI does not feel. It does not experience fear, greed, uncertainty, or pressure. And while that helps remove emotional decision-making, it also creates a gap in understanding, because markets are driven by human behavior. Prices don't just move based on data. They move based on how people react to that data. Panic selling, hype-driven buying, herd mentality, these emotional forces shape the market in ways that are difficult to quantify AI can observe patterns of behavior, but it does not truly understand the emotional intensity behind them. And sometimes, that emotional context is what drives major market movements. AI often presents information in a way that feels highly confident. Structured answers, clear logic, data-backed reasoning, it all creates a sense of precision. But confidence is not the same as accuracy. Just because something is explained clearly does not mean it is guaranteed to be correct. This is where many beginners fall into a trap. They assume that AI-generated insights are more reliable simply because they sound logical. But investing is not about perfect answers. It's about managing uncertainty. And AI, despite its capabilities, cannot eliminate uncertainty. Another major limitation of AI in investing is its inability to fully understand personal context. Every investor is different. Risk tolerance, financial goals, income stability, emotional comfort, these factors vary from person to person. AI can provide general strategies based on data, but it does not truly know your situation. It cannot fully understand how you will react under pressure or what your long-term priorities are beyond what you tell it. A financial advisor, on the other hand, can interpret these nuances through conversation and experience. This is why relying solely on AI can sometimes lead to decisions that are logically sound, but not personally suitable. When you take advice from a human, there is a sense of shared responsibility. There is someone to question, someone to discuss decisions with, and someone who can be held accountable with AI. That responsibility disappears. Every decision becomes yours. And while that independence can be empowering, it also increases risk. Because without accountability, it becomes easier to make decisions without fully thinking them through. This is a psychological factor that many people underestimate. So if AI has all these limitations, what is its real role? The answer is simple. AI is a tool, a very powerful tool, still just a tool. It is designed to assist decision-making, not replace it completely. It can analyze data faster than any human, identify patterns, and provide structured insights. But the final decision should always involve human judgment, because investing is not. It's just about data, it's about context, behavior, long-term thinking. The smartest investors don't blindly follow AI. They use it strategically. They use it to gather information, explore different scenarios, and challenge their own thinking. They treat AI as a second perspective, not the final answer. This approach creates balance. You benefit from AI's speed and structure while still applying your own judgment and understanding. And that balance is where real strength comes from. Understanding limitations is not a weakness, it's an advantage. Because when you know what something cannot do, you stop expecting it to do everything. You use it more effectively. You avoid blind trust, and you make better decisions. In investing, this awareness can save you from costly mistakes, because the biggest risks don't come from tools. They come from how people use them. AI is changing the world of investing. It is making information more accessible, decisions faster, and strategies more structured. But it is not perfect, and it never will be. Because markets are complex, unpredictable, and driven by human behavior. The real advantage is not choosing between AI and human thinking, it's combining both. Because when you use AI as a tool, instead of a replacement, you create a system that is both intelligent and adaptable. And that is what smart investing looks like in 2026. If this video helped you understand AI in a more realistic and practical way, make sure to like this video and subscribe to the channel. I focus on giving you clarity, not hype, so you can actually make better financial decisions. And tell me in the comments, do you trust AI completely when it comes to investing? Or do you think human judgment still matters more? Because in the end, the smartest decisions are not made by tools alone. They are made by people who understand how to use them.